Welcome to Talk Tickers, your deep dive into the numbers that matter. Today we're unpacking O'Reilly Automotive Inc.'s second quarter 2025 results. We've got quite a bit of interesting data for you. It really shows how the automotive aftermarket is navigating, well, a pretty dynamic environment right now.
That's right. O'Reilly's recent call, it offers a really crucial snapshot. We're talking consumer trends, how they're managing that huge supply chain, and their strategic moves for growth.
Yeah, and we'll be focusing not just on, the raw figures.
Exactly. More on the strategic implications behind them, what it really means for you, our listener, if you're watching this sector.
Okay, let's get straight to the Q2 2025 numbers then. O'Reilly delivered a solid 4.1% increase in comparable store sales.
And that's sales from stores open at least a year, right?
Exactly. It's a key metric because it strips out new store openings, tells you about the core business health. And this performance pushed their year-to-date comp growth right to the high end of their own guidance.
Which is pretty strong.
It is. And those robust sales, they fueled an 11% bump in earnings per share, hitting $0.78 for the quarter. Total sales surged by an impressive $253 million.
Yeah, those are solid top-line numbers. But what's particularly insightful here is the makeup of that sales growth.
Right.
Their professional business, serving garages, repair shops, that was the standout performer. Comp sales there climbed over 7%.
Wow, over 7%.
Yeah, and that was largely driven by just consistently more repair orders, more ticket counts from those shops.
Okay. And the DIY side, the do-it-yourselfers like us.
Well, they also saw positive overall sales growth on the DIY side, though they did mention a slight dip in DIY ticket counts right as they exited the quarter.
Ah, okay.
But, and this is important, the average ticket size continues to be a really significant tailwind for both sides, professional and DIY.
So people are spending more each time they come in. Why is that?
Well, it's partly, vehicles are just getting more complex to repair. That often means more specialized, maybe more expensive parts.
Makes sense.
And partly, it's down to their effective pricing strategies, too. They're managing that well. And to top it off, their gross margin.
Yeah, that number looks strong.
Exceptionally strong. Came in at 51.4%. That handily beat expectations.
Okay, so 51.4% gross margin, strong comps, especially on the pro side. Sounds great on the surface. But let's maybe unpack this sales performance a bit more, dig into the market dynamics. They mentioned April and May were strong, but June moderated slightly.
Yeah, they pointed to weather patterns and also some tough comparisons to really strong sales last year in June.
Okay, so what's your take on that kind of monthly cadence? What does it signal about, the broader consumer landscape for auto parts?
Well, I think this cadence gives us a kind of nuanced view of consumer behavior, right? The outperformance early in the quarter, then a softer June. It suggests maybe a bit of volatility.
Okay.
And if we connect this to the bigger picture, O'Reilly reported really robust performance in essential maintenance categories.
Yeah.
Things like oil, filters, spark plugs, undercar parts too.
They must do repairs.
Exactly. And that's important because it reflects these underlying trends we keep talking about.
Yeah.
An aging vehicle fleet cars are just older, and people are willing to prioritize keeping their existing cars running.
Especially when new cars are so expensive.
Precisely. You hold on to what you have, you keep it maintained. But they also noted continued softness in what they call discretionary categories.
Things people might put off.
Yeah, maybe appearance items, accessories, things like that, mostly on the DIY side. Now, these are a pretty small part of their total sales.
Right.
But that sluggishness is still a clear signal, I think, that consumers are exercising some caution with household spending on non-essential stuff.
So it raises that question, doesn't it? How resilient is this business, even though it's mostly non-discretionary repairs, if consumers really start tightening their belts across the board?
That's the key question. Can they withstand broader spending caution? Will people start deferring even some essential repairs if things get really tough? It's something to watch.
Definitely. Okay, let's shift gears a bit to profitability. Gross margin and SGNA. You mentioned the strong gross margin, 51.4%. They said supply chain management helped, but also a timing benefit from tariffs.
Yeah, that's right. They got a bit of a timing benefit from some earlier tariff-related cost adjustments flowing through.
Okay, but then on the flip side, their selling, general, and administrative expenses, SGNA, per store grew 4.5%. That was actually above their expectations.
It was. And they put that down to a mix of things, Some incremental spending needed to support those higher sales volumes, plus inflation hitting areas like medical and casualty insurance costs.
So what does this tell us about O'Reilly's cost structure overall? And, are these higher costs just the price of growth, or is it something more concerning?
Well, you've hit on a really important tension there. The gross margin strength was partly helped by that tariff timing, like you said. But importantly, management was very clear. They are not projecting a significant net benefit from tariff inflation in the back half of the year.
Why not? If costs go up, don't they pass it on?
They're being cautious, largely because of their read on consumer health. They don't want to push pricing too hard if the consumer's already stretched. They're actively working with suppliers, trying to mitigate the full impact of any, incremental tariffs.
Okay, managing the margin carefully. What about the SGNA side? Those costs being up.
Right. So while costs are up, and they did exceed their internal targets, management really frames these as strategic investments.
Investments? In what?
Well, things like enhancing customer service, optimizing operations, making sure they have the staff and support for those higher sales. They believe these initiatives are directly enabling the market share gains they're seeing.
So it's a long-term play. Spend now to gain share later.
Exactly. It highlights that classic long-term focus. They seem willing to absorb some short-term expense pressure if it means gaining operating leverage down the road through increased market share.
And they feel the competitive environment allows for that.
They noted the industry typically behaves pretty rationally on pricing. They aren't seeing any unusual price gaps between competitors right now, which suggests a stable environment for them to execute this strategy.
That long-term focus definitely seems to shine through when you look at their strategic investments too. I mean, beyond the quarterly numbers, this is where you really see their ambition, right?
Absolutely.
The expansion plans, they opened 105 new stores just in the first half of 2025, U.S. and Mexico.
Steady rollout.
But the big news was the acquisition of that massive new distribution center, DC, in Fort Worth, Texas. 560,000 square feet, expected online in 2027.
Yeah, that's a significant move. And they're also nearing completion on another DC in Virginia, right? Due by year end.
That's right. So what do these huge new facilities actually enable for them? How does this fit into their bigger competitive strategy?
Look, these new DCs are absolutely pivotal. They're central to the long-term growth strategy and their ability to grab even more market share in what still, believe it or not, a highly fragmented industry.
Fragmented even with players like O'Reilly.
Oh, yeah. Think of these DCs as the central nervous systems for their store network. The Fort Worth one, for example, serves the South Central U.S., including Texas, a really mature, profitable market for them.
Okay.
But crucially, it doesn't just add capacity there. It frees up needed capacity in other nearby DCs. So it helps them support growth across that whole region more efficiently.
Right. It has knock-on benefits. And the Virginia one.
The Virginia DC, well, that's a potential game changer. It unlocks the Mid-Atlantic region. O'Reilly sees that area as a significant, largely untapped, kind of last frontier for their U.S. expansion.
Really? Untapped.
Relatively speaking for them, yes. Yeah. Think about the potential. They're huge population, massive number of cars on the road, major metro areas like Northern Virginia, D.C., Baltimore, Philly, maybe even pushing towards New York City eventually.
Wow.
So these investments, they're all designed to give their store teams rapid, industry-leading access to inventory. And in this business, having the right part right now, that is absolutely critical for driving market share.
Especially for those pro customers.
Especially for the pros, but even for DIY. If you're stuck on a Saturday afternoon, you want the part now. And remember, O'Reilly currently holds only about 10% market share in the U.S.
Only 10%. Feels like they're everywhere.
It does, but the market is huge. So these strategically placed hubs give them a massive runway for growth.
That really puts it in perspective. Okay, let's bring this full circle then. Connect it back to you, the listener. With all these moving parts, you've got tariffs, a cautious consumer, these big strategic investments. What are the key takeaways for someone considering the auto aftermarket sector, maybe O'Reilly specifically?
Well, look, O'Reilly's management, they acknowledge the consumer caution.
Yeah.
They know that particularly the lower income DIY customers might put off spending if prices jump too quickly. However, they really emphasize the historical resilience of their customer base. This market has weathered short-term shocks before tariff inflation, gas price spikes, recessions.
Right. People still need their cars to work.
That's the fundamental driver. The demand drivers are incredibly solid. You've got the aging, but also higher quality North American vehicle fleet cars last longer, need more repairs over their lifetime.
Yeah.
You've got growth in the total number of cars on the road, the car park.
Yep.
And you've got miles driven generally trending up over the long term.
So the need is there.
The need is definitely there. And what this all means is that essential repairs, which are the vast majority of O'Reilly's sales, they remain largely non-discretionary. People have to do them.
Okay.
Now, sure, some deferrals can happen at the margins, but history shows they tend to normalize. And interestingly, management explicitly views these periods of challenge like tariffs, not just as obstacles, but as genuine opportunities.
Opportunities? How so?
They believe their strong balance sheet, their massive distribution network, those long-standing supplier relationships, it all positions them uniquely to gain market share from smaller, maybe less capitalized competitors who might really struggle to absorb rising costs or navigate supply chain kinks.
So they can press their advantage when others are weak.
In essence, yeah. They're playing offense during potentially defensive times for the broader economy.
All right, well, speaking of playing offense, it's time for our This Is Not Financial Advice segment. This is where we throw out an outrageous but plausible trade idea purely for entertainment, for thought-provoking purposes only.
Okay, let's have some fun with this. Given everything we've just discussed, O'Reilly's strategic DC expansion, that explicit focus on grabbing market share from weaker players, the fact that this industry is consolidating. Here's a thought for you. Consider what's known as a long-short pair trade.
Okay, break that down.
You take a long position in O'Reilly, basically, betting its stock price goes up. But simultaneously, you take a short position betting the price goes down in a basket of smaller, regional, maybe publicly traded auto parts distributors. Or even, if you could track them, some closely watched private independents.
So long the big guys, short the smaller ones. What's the logic?
The core thesis is pretty simple. O'Reilly's huge capital deployment into these new DCs and stores, especially in underserved markets, positions them to just systematically take market share. They might even be able to consolidate, maybe buy up distressed assets from less resilient competitors.
Especially if the economy or tariffs put pressure on those smaller guys?
Exactly. Those conditions would likely hit the smaller players harder. So this trade tries to capitalize on O'Reilly's long-term structural advantage, their operational excellence, while theoretically hedging against a broader market downturn through those short positions on the weaker players.
It's kind of a bet on industry consolidation, led by the strongest player.
Precisely. It's an asymmetric bet, really, on smart capital allocation within a defensive sector. Again, purely speculative, not advice. But makes you think about how these dominant companies can really leverage their strengths during times of change.
It definitely does. Okay, so just to recap our deep dive today, O'Reilly Automotive put up solid Q2 results. Strong professional sales really drove those comparable store sales numbers.
That was key.
They're navigating the tariff complexities, keeping a cautious eye on things, acknowledging consumers' sensitivities.
Right, they're not ignoring the potential headwinds.
But they remain pretty confident in the underlying resilience, the fundamental drivers of the auto aftermarket. And those huge investments in distribution and new stores, they really underscore a clear long-term strategy for market share expansion and what's surprisingly still a very fragmented industry.
Absolutely. I think the key takeaway for you, our listener, is that this company isn't just, reacting to the market day to day. They're playing the long game here.
Yeah.
They're leveraging their operational strengths, making these big strategic capital bets to capitalize on industry shifts, and really looking to consolidate their dominant position.
It really makes you consider, doesn't it? In an economy where maybe consumers are getting more cautious, which businesses are truly essential.
And how will that definition of essential shape the winners and losers in the years ahead? It's a fascinating question to ponder.
It certainly is. Well, thank you for joining us on Talk Tickers for this deep dive. We appreciate your insights.
Always a pleasure.
And we look forward to our next deep dive into the numbers.